A mid-January wind moved down Fifth Avenue like an accountant's eraser, stripping color from the stone. On 15th of January 1925, inside Alice Gwynne Vanderbilt's block-long mansion at Mirror West 57th Street, a clerk in a dark waistcoat steadied a fountain pen over a pale government form. On his desk, a green-shaded lamp was nudged a fraction closer to the margin marked Total Net Income. In another room, Alice adjusted a vase of white flowers on a marble console, an ordinary domestic gesture that hid the purpose of the morning, signing away the largest private house in Manhattan to a developer. Later, writers would trace the pressure in her ledgers to the 16th Amendment of 1913 and the new federal and local tax regime that turned palaces into liabilities. Outside, Fifth Avenue looked calm, the traffic of carriages and early motorcars unremarkable. Inside, every signature exchanged memory for liquidity. The mansion's electric chandeliers still burned, but the real light in the room came from the green lamp on the tax form. The story that began on that line would outlast the house itself. On a clear evening in December 1895, as guests arrived at George Vanderbilt's new estate outside Asheville, North Carolina, the United States had no federal income tax and no reason in Vanderbilt's circle to imagine one returning. The great house they entered, Biltmore, with more than 250 rooms, central heating, hydraulic elevators, and electric lighting, was financed from a fortune built when railroads, shipping, and compound interest were taxed lightly at the federal level and regulated even less. The timing was not accidental. The Supreme Court had struck down a federal income tax only months earlier in Pollock v. Farmers Loan and Trust Company, ruling in April 1895 that such a tax constituted an unconstitutional direct tax requiring apportionment by population. For men like Vanderbilt, the decision meant more than legal vindication. It meant architectural permission. If income would remain largely untaxed at the federal level, then income could be converted into stone with confidence that the structure would remain a private family asset rather than a public liability. In photographs, carriages and a few early motorcars pull up beneath the limestone facade. Behind their lamps, the Blue Ridge winter is black and quiet. Inside, a house steward notes in his daily report the number of staff on duty and the coal consumed in the boilers, a private operational log for a domestic machine. The numbers are impressive. Approximately 80 servants are required to run the house, stables, and gardens, with coal deliveries measured in tons per week during winter months. At roughly the same time, on Fifth Avenue in New York, Cornelius Vanderbilt II is finishing his own statement of power, the enlarged mansion at Verd West 57th, occupying an entire block front between 57th and 58th Streets, with over 130 rooms. Contemporary images from the Detroit Publishing Company and the Library of Congress show the French-style palace framed by streetcars and horse-drawn vehicles, its upper windows glowing above a dark avenue. The scale requires documentation to grasp. The house stretches 268 feet along Fifth Avenue and runs 215 feet deep. It contains a ballroom that can accommodate 1,000 guests, an art gallery designed to rival European museums, and domestic quarters that include separate apartments for family members, guest suites, and an entire wing devoted to servants' rooms and service functions. The limestone facade alone cost what many American families would earn across generations. In ledgers kept by household accountants, the expenses, wages for dozens of servants, coal, food, repairs, are simply items on a list, offset by investment income that appears limitless. A typical monthly accounting might show $3,000 in wages, $800 in coal, $500 in food, $200 in flowers and plants, and miscellaneous repairs ranging into hundreds more. These sums are noted without concern because they represent a tiny fraction of the monthly income from railroad dividends, real estate rents, and industrial investments. The micro-routine in such houses is domestic, not strategic. A butler straightens silver frames, a housekeeper checks the linen inventory, a secretary sharpens a pencil over a private ledger, not a government form. The only operation is hospitality. In later decades, those same rooms will be read like cover legends, disguises for a financial structure that never anticipated scrutiny. The first fact of these palaces is that they were built in a world where the federal government had chosen, for a time, to look away from private income. The line that would someday threaten them did not yet exist in any form. By summer 1900, Newport, Rhode Island, had become a seasonal showroom of untaxed capital. On Bellevue Avenue, Cornelius Vanderbilt II's summer house, The Breakers, 70-plus rooms overlooking the Atlantic, operates for 6 weeks as a statement that fortunes may be turned into stone and remain untouched. Visitors later described the staffing pattern in terms that recall hotels more than family homes: dozens of maids and footmen, cooks, gardeners, coachmen, and grooms on call for a single season. The Breakers represent a particular calculation. Built at a cost of approximately $7 million in the early 1890s, it functions as a summer residence occupied for perhaps 8 weeks per year. The rest of the year, a skeleton staff maintains the property, heating select rooms to prevent damage, conducting routine maintenance, and preparing for the next season's opening. The annual carrying cost, staff, utilities, repairs, local taxes, runs into tens of thousands of dollars for a house used less than 1/6 of the year. In this world, the palaces are not only residences, they are arguments against political change. In congressional debates recorded in the Congressional Record, Representative Cordell Hull and other income tax advocates point explicitly to mansions and extravagant expenditures as examples of wealth escaping any proportional share of federal burden. Their speeches are the archival equivalent of surveillance notes, precise, repetitive references to visible houses that the owners assumed were beyond state reach. Hull, a Tennessee congressman who would later serve as Secretary of State, became particularly focused on the taxation question. In floor speeches preserved in the record, he repeatedly invoked the image of palatial homes and elaborate lifestyles as evidence of concentration of wealth that contributed nothing to federal revenues. His rhetoric was measured but pointed. While working families paid tariffs embedded in the price of every purchased good, the richest Americans paid nothing on the investment income that funded their mansions. In a New York drawing room in 1902, a private banker reviews a portfolio for a client whose Fifth Avenue house cost more than many factories. His notes mention railroad bonds, industrial shares, and municipal issues. There is no entry marked federal income tax. The clerk who prepares the summary adjusts a desk lamp, the same small gesture seen in private offices across the financial districts of the day. The light falls only on private numbers. The banker's calculations are straightforward: annual income from investments totaling perhaps $500,000, annual expenses including multiple households totaling perhaps $100,000, leaving $400,000 that can be reinvested or spent at the family's discretion. No federal authority claims a share. The only taxes are local property assessments and modest state levies, easily absorbed within the expenditure budget. As long as the fiscal state relied on tariffs and excise taxes, the Gilded Age houses functioned like unexamined safes, visible, impressive, and effectively sealed. The first serious attempt to open them would arrive through a court case, not a wrecking ball. On 8 April 1895, the Supreme Court's decision in Pollock v. Farmers Loan and Trust Company strikes down a previously enacted federal income tax as unconstitutional, classifying it as a direct tax requiring apportionment by population. The ruling, reported in the national press, reads from the perspective of the mansions like a stay of execution. For wealthy property owners, the legal language translates into time. The case itself centered on the constitutionality of income tax provisions in the Wilson-Gorman Tariff Act of 1894. The court's decision, delivered in a 5-4 vote after rehearing, held that taxes on income from property were effectively taxes on the property itself, and thus required apportionment among states based on population, a practical impossibility that effectively nullified the tax. Justice Stephen Field's concurring opinion used language that would be quoted for decades. The present assault upon capital is but the beginning. It will be but the stepping stone to others, larger, and more sweeping, till our political contests will become a war of the poor against the rich. The rhetoric revealed the class anxieties beneath the legal reasoning, a fear that democratic politics might enable redistribution through taxation. In New York that spring, a real estate map of Fifth Avenue between 50th and 70th Streets Looks like a roster of industrial empires: Vanderbilt, Astor, Carnegie. The houses grow larger, not smaller, in the wake of Pollock. Architects McKim, Mead and White, and Richard Morris Hunt draw up plans that assume a future of private fortunes undisturbed. The architectural boom of the late 1890s and early 1900s reflects this confidence. William K. Vanderbilt builds Marble House in Newport for $11 million. Andrew Carnegie constructs his mansion at 91st Street and Fifth Avenue with 64 rooms. The Clark family erected a 121-room palace on Fifth Avenue. Each project assumes that the wealth-funding construction will remain largely untaxed, that operating costs can be sustained indefinitely, that the next generation will inherit both fortune and mansion intact. Inside an architect's office, a junior draftsman sands graphite from a blueprint showing gala staircases and ballrooms, unaware that the constitutional question he has just read about will be reopened within a decade. The drawings specify Italian marble, French silk wall coverings, hand-carved woodwork, and electrical systems requiring their own power plants. The scale assumes permanence. Yet, outside the parlors, the political climate shifts. Progressive reformers, journalists, and labor organizers compile their own unofficial dossiers on excess, describing dinners where guests eat beneath imported ceilings while workers strike in the streets. Hull and his allies continue to argue for a fair tax reaching the incomes behind the houses, an early attempt to link visible architectural privilege to invisible tax policy. The muckraking press plays a role. Articles in McClure's magazine and other progressive publications document the contrast between mansion and tenement, between the cost of a single dinner party and the annual wages of a factory worker. The houses become evidence in a political argument, their very visibility making them vulnerable in ways their owners don't yet recognize. The ruling in Pollock did not end the conversation about taxing great fortunes. It simply pushed it sideways, buying the Gilded Age houses a little more time to grow. When the question returned, it would arrive not as a court case, but as a single sentence added to the Constitution. On 3rd February 1913, the 16th Amendment was ratified. On 3rd March 1913, Representative Cordell Hull sat in his office in Washington, D.C., revising draft language for what would become the income tax section of the Revenue Act of 1913. Cambridge legal histories describe that moment bluntly. Hull is writing the income tax in a capital that has just been granted clear constitutional authority to reach private incomes. The amendment's language is deceptively simple. The Congress shall have power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. 39 words that reverse Pollock and open every stream of investment income to federal taxation. The ratification process itself had been surprisingly swift once momentum built. Proposed by Congress in July 1909, the amendment moved through state legislatures over the following years, with progressive Western and Southern states ratifying quickly. The final ratification came from Delaware, Wyoming, and New Mexico in early 1913, just as the Wilson administration prepared to take office. The first return forms mailed in 1914 are simple compared to modern standards, but on one line in black print appears a concept unprecedented in Gilded Age circles: taxable net income from all sources. Educational accounts of that first collection day, 1st March 1914, note that few Americans earned enough to owe anything. Under 4% of families cleared the threshold. But those who did included men whose houses were already landmarks on Fifth Avenue and Bellevue Avenue. The initial rates were modest: 1% on income above $3,000 for individuals, $4,000 for married couples, with a progressive surtax reaching a maximum of 6% on incomes above $500,000. These rates seemed almost to the very wealthy, barely affecting their capacity to maintain multiple palatial residences. But the principle was established. Private income was now subject to ongoing federal claims. In a New York law office that winter, an attorney and accountant reviewed a client's holdings: railroad shares, real estate rents, bonds, foreign investments. The accountant moves the green-shaded lamp closer and tests his steel nib on scrap paper before copying totals into the boxes on the new federal form. He writes carefully, "A mistake could invite an audit, a new kind of federal intrusion into a world used to negotiating only with local tax assessors and bankers. The client whose return is being prepared owns a Fifth Avenue mansion, a Newport cottage, and a country estate in the Hudson Valley. His annual income from investments approximates $800,000. Under the new law, he will owe roughly $15,000 in federal tax, less than 2% of his income, easily absorbed. What concerns him more is the precedent. The government now has access to his financial information, can track his income sources, and has established a right to claim an increasing share if Congress chooses to raise rates." Outside, carriages and automobiles slide past the marble facades in muffled snow. Nothing about the houses has changed. What has changed is the unseen line between private ledgers and the Treasury. For the owners of America's palaces, the income tax did not feel like a direct assault at first. It felt like a new, faintly unwelcome light pointed at the money behind the stone. The next tax would aim not at income itself, but at what happened when a fortune and the house it had built passed from one generation to the next. In September 1916, Congress enacted the modern federal estate tax, adding a new layer to the financial calculations surrounding large properties. A curbed historical survey of Gilded Age mansions notes that the 1913 income tax and the 1916 estate tax together seriously curtailed the previously unlimited funds that maintained these houses like hotels, absorbing vast staffs and constant repairs. The estate tax was initially imposed at rates ranging from 1% on estates over $50,000 to 10% on amounts over $5 million. Like the income tax, it started modestly but established a principle. Wealth transfers at death were now taxable events. For families whose primary asset was an enormous mansion filled with art and furnishings, this created a new kind of vulnerability. In a Philadelphia banking office on Broad Street in 1917, an estate attorney maps out potential liability for a client whose main assets include an enormous city house and a country estate. The memorandum he prepares, still in the archives of several old banks, lists possible strategies: inter vivos gifts, trusts, corporate structures to hold real estate. Every option assumes that the house is now part of a taxable corpus, not an untouchable family symbol. The calculations are sobering. A mansion valued at $5 million when passed to heirs would trigger a state tax of $500,000. If the estate consists primarily of the house and its contents rather than liquid assets, the heirs might be forced to sell art, furnishings, or even the property itself to pay the tax. The house that was meant to be a family seat for generations becomes instead a potential tax trap. At the same time, in Newport, preservationists and local historians would later note, the first cracks appear in the seasonal ritual. History.com's account of Newport's Gold Coast describes how the city's Gilded Age fantasy began to unravel after the introduction of federal income tax in 1913 with World War I and the 1929 crash delivering later blows. Some families cut back on the length of their stays, others quietly sell secondary houses. The pattern is subtle at first. A family that once opened their Newport house from June through September might now operate it only in July and August. Staff who were once retained year-round are let go at season's end and rehired the following spring if positions are still available. The ballroom that hosted weekly dinners for 100 guests might now see only 2 or 3 events per summer. In correspondence preserved by the Preservation Society of Newport County, there are early hints of concern. Notes from local figures about shuttered windows on Bellevue Avenue, unpaid maintenance, and aging servants. A gardener writes of working 1 year and dismissing the next, the human version of a line, on a balance sheet erased to maintain liquidity. The letters reveal the personal cost. Servants who had built careers in these houses, who had expected lifetime employment in the aristocratic European model, found themselves unemployed as families economized. The houses themselves began to show signs of deferred maintenance, paint fading, gardens less meticulously kept, minor repairs postponed. The estate tax reframed the great houses as problems to be solved before death, architectural legacies that could trigger fiscal penalties rather than simply surviving their owners. When the war ended, the tax rates that had been raised as temporary measures did not entirely retreat, and the properties they touched were now exposed. By 1919, after the U.S. had financed its involvement in World War I with higher rates and broader brackets, the income tax had transformed from a narrow levy on millionaires into a primary engine of federal revenue. Analyses of the period note how wartime legislation raised top marginal rates dramatically and expanded the taxpayer base, cementing the income tax as a permanent feature of American life rather than an emergency measure. The progression was rapid and dramatic. The Revenue Act of 1916 raised the top rate to 15%. The 1917 War Revenue Act pushed it to 67% on incomes over $2 million. By 1918, the top rate reached 77%. Even after the war, rates remained far higher than the pre-1913 era, with top brackets hovering around 70% through the early 1920s before settling at 25% by 1925. For mansion owners, this represented a fundamental shift in economic reality. An investor with $1 million in annual income, who once paid nothing in federal tax, now faced bills of $200,000 or more depending on the exact year and their deductions. The houses didn't just compete with other expenditures, they competed with the federal government's claim on income. In New York, this coincides with a shift in the value of land under mansions. The intersection of Fifth Avenue and 57th Street, once a residential stronghold, is increasingly surrounded by commercial towers. Real estate reports from the New York Times in the 1920s, later summarized by historians, quote developer Benjamin Winter, explaining that the true cost of a mansion must include both its opportunity cost, the return on its land value, and rapidly rising taxes and staff expenses. Winter's calculations, preserved in interviews and legal depositions, provide specific numbers. A Fifth Avenue mansion on a lot worth $4 million as residential property might be worth $8 million if sold for commercial development. The annual income from that $4 million difference at 5% interest would be $200,000, money the homeowner is effectively forfeiting by keeping the house. Add to that $50,000 in property taxes, $80,000 in staff wages, $20,000 in utilities and maintenance, and the true annual cost of occupying the mansion approaches $350,000. Contemporary photograph shows cars lined up in front of the Cornelius Vanderbilt II house around 1904, already turning the residential avenue into a traffic corridor. 2 decades later, the ledger entries for such a house include numbers that dwarf pre-tax era assumptions, tens of thousands of dollars annually in property tax alone, layered on top of federal obligations. Meanwhile, in North Carolina, Biltmore's owner, Edith Vanderbilt, begins to feel similar pressure. A later historical summary of the estate notes that after the passage of income tax and facing the estate's vast maintenance costs, she initiated the sale of large tracts of land to the federal government, land that would become part of Pisgah National Forest. The sale of approximately 86,000 acres to the federal government in 1915 brought $5 per acre, far below market value, but acceptable to Edith as a way to ensure preservation while reducing her tax burden. The decision is recorded in legal deeds, but behind the formal language is a simple equation. Income is now scrutinized and finite, while the house remains enormous and fixed. In a post-war America of shifting markets and higher public claims on private income, the great houses' greatest strength, their mass, became their chief weakness. The next phase would not be about new laws, but about how individual families chose to surrender, defend, or repurpose their palaces under those laws. On a gray morning in 1924, in a sitting room at the Breakers in Newport, Alice Gwynne Vanderbilt reviews figures with her advisors. A later architectural and social history of the family reconstructs the numbers. By the mid-1920s, she is paying about $80,000 a year in taxes on the Breakers and $130,000 on Bador's West 57th Street, amounts that consume most of the income from the trust her husband left her. Alice's situation exemplifies the squeeze facing mansion owners. Her husband, Cornelius Vanderbilt II, died in 1899, leaving her a trust designed to provide comfortable lifetime income. The trust was calculated for a pre-income tax world where perhaps $300,000 in annual income could easily support two enormous houses and their attendant staff. By 1924, after federal income taxes, estate planning costs, and rising local property taxes, that same income barely covered the house's operating expenses. The record of those taxes exists in city rolls and private correspondence, but the decision they force is human. To economize, Alice reportedly opens the breakers only every other summer, closing the shutters and dismissing staff in off years while still maintaining a reduced crew to prevent decay. Even her version of austerity, leasing a Paris hotel particulier rather than operating one of her American houses, signals the scale of adjustment required. Her correspondence from this period, preserved in various archives, reveals the psychology of the transition. She writes to relatives about the difficulty of maintaining standards while managing costs, about the necessity of making practical arrangements that would have seemed unthinkable a generation earlier. The houses that represented permanent family seats now feel like temporary accommodations subject to annual recalculation. In the background, the green-shaded lamp motif returns. In her New York lawyer's office, an aide adjusts such a lamp before drafting the preliminary terms of sale for the Fifth Avenue house. The files include mortgage details, developer bids, and a discreet acknowledgement that her sons cannot afford to take on the property. The house that once stood as an unambiguous emblem of family dominance has become a liability with a carrying cost documented down to the dollar. The decision to sell is not made lightly. Family meetings are convened, alternatives explored, appeals made to see if the next generation might find a way to keep the house, but the numbers are unforgiving. Annual operating cost, $220,000. Annual income available after taxes and other obligations, $250,000. The margin is too thin, the risk too high that an economic downturn or change in tax law could make the house catastrophically expensive. For Alice Vanderbilt, the confrontation with the income and property tax regime was not ideological. It was arithmetic written in her own hand across the balance sheets. Within a year, the largest private house in Manhattan would be sold, and its demolition would be treated in the press almost like a state funeral. In 1925, Alice sold 1 West 57th Street to developers for about $7 million, a sum that roughly doubles her liquid fortune but seals the fate of the house. The sale is recorded in city deeds and chronicled in newspapers as one more sign that Fifth Avenue is transitioning from residential row to commercial corridor. The transaction details tell their own story. Purchase price, $7 million. Of that, approximately $5 million represents the land value. The house itself, despite costing millions to build, adds relatively little. The developer's plans filed with the city call for complete demolition and construction of a commercial building. The limestone, marble, and carved woodwork that took years to install will be removed in months. Photographs from 1926 show the Cornelius Vanderbilt II house under demolition, its carved stone and ironwork tumbling into the street as workmen methodically remove ceilings and walls. A widely cited New York Times interview with developer Benjamin Winter, quoted in later histories, calculates that a $4 million Fifth Avenue home effectively costs hundreds of thousands per year when one includes taxes, servants, and maintenance, explaining why even the richest owners chose to sell. Winter's explanation became the standard narrative. When you consider that taxes and upkeep on such a property run to $200,000 annually, and that the same capital invested commercially might earn $300,000, you see that living in the mansion actually costs $500,000 per year. No family income can sustain that indefinitely. The logic was unanswerable in purely economic terms. The operation is clinical, permits issued, crews hired, salvage cataloged. The house's grand staircase, once the route for guests ascending in gowns and tails, is now a path for laborers carrying out marble pieces. For a few months, the site is a raw gap in the avenue's architectural narrative, documented in city planning files and in the photographs of passers-by. Salvage records show some materials sold to other buildings or collectors. Mantels purchased for new country houses, bronze fixtures repurposed, carved stone elements saved for museums. But most of the house simply becomes rubble, carted away and used as fill or crushed for aggregate. Decades of craftsmanship reduced to construction waste in a matter of weeks. In the same period, another great house, Senator William A. Clark's 121-room mansion on Fifth Avenue, opened briefly to the public before its own demolition, charging small admission fees for charity. A New York Times piece notes that even Charlie Chaplin toured its paneled halls before the wrecking crews arrived. The Clark House demolition drew particular attention because of its timing. Built in 1911, demolished in 1927, it lasted barely 15 years. The mansion had cost $7 million to construct. It sold for $28 million and was immediately razed. The house represented wealth that had arrived too late, built just as the tax regime that would make such houses unsustainable was being established. Demolition, in this context, is not vandalism. It is the final step of a rational calculation in a tax and real estate environment that has found the house's previous use unsustainable. Not every family chose the wrecking ball. Some chose to turn their private palaces into semi-public fortresses. In March 1930, Cornelia Vanderbilt Cecil and her husband John Cecil opened Biltmore House to the public for the first time, working with officials from Asheville, North Carolina, who hoped that tourism would ease the economic pain of the Great Depression. Estate and local histories agree on the dual purpose, to stimulate the local economy and to generate revenue to support the estate itself. The decision represents a fundamental shift in the house's identity. Built as the ultimate private retreat, Biltmore would now admit strangers for $1 per person. The Cecils carefully controlled the transformation, limiting tours to certain routes, keeping family quarters private, and training staff to serve as guides rather than personal servants. Ticket prices and visitor counts are tracked in new ledgers that sit alongside older volumes listing coal deliveries and staff wages. The operational logic of the house shifts. Rooms that were once closed to outsiders become part of a carefully staged route. Staff retrain as guides, private corridors remain off-limits. In the archives, correspondence between the Cecils and the Asheville Chamber of Commerce explains how train timetables, bus routes, and marketing copy are coordinated, transforming what was a private mountain retreat into a managed attraction. The first year brings approximately 40,000 visitors, generating roughly $40,000 in gross revenue. After operating costs, additional staff, maintenance, marketing, the net contribution to the estate's budget is modest but meaningful. More importantly, the house has found a new justification for its existence beyond family residence. The green lamp motif appears again, now on a cashier's table in a converted cloakroom where clerks count ticket receipts under the same color of glass that once illuminated private household ledgers. The object is the same. The flow of money has changed direction. Where once money flowed out to maintain private splendor, now it flows in from public curiosity. Elsewhere, similar transitions unfold. In Newport, Countess Gladys Vanderbilt Szechenyi leased the breakers to the newly formed Preservation Society of Newport County in 1948 for a nominal fee, enabling public tours to fund maintenance. The Society's records show the practical details, staffing, tour scripts, repair budgets, that turn a symbol of private excess into a kind of historical infrastructure. The Society's approach was methodical. Tours were organized by trained docents who followed prepared scripts. Visitor numbers were limited to prevent overcrowding. Room temperatures and humidity were monitored to protect furnishings. Admission fees started at $1.50 and gradually increased, creating a sustainable funding model that could support ongoing conservation. The transition was not without resistance. Some family members felt it unseemly to turn their homes into tourist attractions. Servants who had worked in the houses during their private era sometimes struggled with the new role of performing their former duties for audiences. But economic necessity overcame social discomfort. Opening the doors was not an act of pure generosity. It was an operational choice in a tax and market landscape that had closed off other options. Even with public visitors, however, the tax obligations and maintenance demands did not disappear, and some houses continued to drift toward ruin. Throughout the 1940s, real estate notices and society columns chronicle a quiet liquidation. A Curbed survey notes that in this decade it became common to read about Newport mansions being auctioned off, their furnishings dispersed and their structures converted or demolished. In many cases, the reason is not a single catastrophic event, but a slow convergence of pressures: federal and state taxes, rising wages, the disappearance of large domestic staff, and changing social expectations. The pattern repeated across the country. A mansion would be listed for sale, attract no buyers willing to maintain it as a residence, and eventually sell at a fraction of its construction cost to an institution, developer, or demolition company. The furnishings, paintings, tapestries, furniture, decorative arts often brought more at auction than the house itself as real estate. In 1945, residents of Newport found the Preservation Society of Newport County to save Hunter House, an 18th-century building threatened by demolition. 3 years later, to raise funds, they organized public tours of the breakers in collaboration with the Vanderbilt family. In 1962, they acquired the Elms, another great house just ahead of its planned raising. Each acquisition is backed by a file of legal documents, fundraising appeals, and architectural reports that read a bit like rescue operations. The Society's archives contain urgent letters to potential donors, architectural surveys documenting deterioration, and financial projections showing how tour revenue might sustain preservation. The houses were saved not through sentiment alone, but through careful planning and sustainable business models. Across the country, similar stories unfold. Some houses are converted to university buildings or apartment houses. Others become hotels or corporate headquarters. Many simply vanish, leaving only photographs and insurance surveys. An archival pattern emerges: a notice of sale, a spike of local news coverage, then silence where a household once provided hundreds of jobs. The Frick Mansion on Fifth Avenue survives by becoming a museum. The Carnegie Mansion becomes the Cooper Hewitt. The Morgan Library preserves J.P. Morgan's study and collections. But these are exceptions, requiring extraordinary endowments and institutional will. Most of the Fifth Avenue palaces disappear entirely, replaced by apartment buildings and office towers. In the background of these files, tax assessments continue to rise with land values. The house's intricate plaster ceilings and marble staircases are not deductible. What matters on paper is square footage and location. The once invisible income streams that built them are now cataloged and taxed. The structures, heavy and inflexible, cannot be moved. By mid-century, the story of America's palaces is less about individual misfortune than about a system in which the combination of progressive taxation and market forces made such properties almost uninhabitable as private family homes. Yet, some fortunes and some houses did adapt, by changing not only ownership, but their very purpose. By 1963, when the Biltmore estate was designated a National Historic Landmark, it had long been more public than private. The designation, recorded in federal registers, cements its status as something like a managed anomaly. America's largest home, preserved within a tax and regulatory framework that would make building its equivalent nearly impossible. The landmark designation brings both prestige and restrictions. The house cannot be significantly altered without federal review, but it also qualifies for certain tax benefits and grants that support preservation. The estate operates as a hybrid entity, privately owned but publicly significant, a family business that happens to steward a national treasure. In Newport, the Preservation Society continues to build its portfolio. Its records in the late 1960s and 1970s show a mix of ticket revenue, donations, and grants, financing ongoing restorations. The palaces that survived do so as educational instruments and tourist infrastructure, their staff now including archivists, curators, and marketing officers rather than butlers and ladies' maids. The ledgers keep track of visitor numbers and conservation costs rather than coal deliveries. Annual reports from this period show the scale of the operation. The breakers alone might welcome 300,000 visitors per year, each paying admission that funds not just that house but the Society's other properties and programs. Staff includes tour guides, conservators, gardeners, security personnel, administrators, Perhaps 100 people supporting a house that once employed 80 as private servants. The recurring motif of the lamp finds its final institutional form in the reading rooms of historical societies and archives, where researchers bend over old photographs of demolished mansions and tax rolls listing former owners. Under the glow of these lamps, the story of how income tax intersected with architecture is reconstructed from fragments, legal briefs, congressional debates, property records, private letters. One researcher examining the Vanderbilt family papers might spend hours under such a lamp, tracing the progression from confident palace building in the 1890s to reluctant sales in the 1920s. The documents tell a story of erosion, not of character or competence, but of a system that made certain forms of display unsustainable. The houses that remain are less fortresses of private wealth than open case files on a particular intersection of architecture, economics, and law. Outside of these curated survivors, the ghost map of vanished palaces overlays modern office towers and apartment blocks. By the late 20th century, changes in federal tax law, including lower top marginal rates after the Tax Reform Act of 1986 and the growth of complex tax planning, altered the landscape again, but in a way that did not revive the age of urban palaces. Wealthy Americans still build very large houses, but often in exurban or gated settings with different cost structures. More importantly, their primary assets are as likely to be held in corporations, partnerships, and funds as in a single showpiece residence. The Tax Reform Act of 1986 reduced top marginal rates from 50% to 28%, later increased to 39.6% in 1993, then reduced again in subsequent decades. This made high income less heavily taxed than in the mid-century period. But by then, patterns of wealth display had fundamentally changed. The very wealthy no longer needed to prove their status through architecture visible from public streets. Law reviews and historical analyses of the 16th Amendment's long-term impact note that it helped normalize the idea that high incomes would be taxed at higher rates, at least for much of the 20th century, and that this encouraged diversification and liquidity over fixed, ostentatious domestic investments. The Gilded Age palaces become cautionary tales in books about family wealth, examples of what happens when assets are tied up in illiquid, high-maintenance structures in a jurisdiction committed to progressive taxation. Modern estate planning emphasizes flexibility and privacy. Wealth might be held in trusts distributed across multiple jurisdictions, in corporate structures that own real estate, in investment vehicles that provide liquidity and can be easily transferred. A billionaire's home might be owned by an LLC leased back to the occupant with tax advantages and liability protections that simply didn't exist in the Gilded Age. In this environment, even ultra-high net worth families tend to treat large houses as parts of portfolios, not as unquestioned centers of gravity. Trusts, corporate shells, and cross-border holdings perform the protective role once assigned, symbolically, to thick stone walls and high gates. The mansions that do exist as private homes are often smaller in staff and more technologically efficient than their predecessors, with far fewer live-in servants and lower relative operating costs. The modern rich still build and buy large houses, but in a tax and regulatory world shaped by the 16th Amendment, almost no one chooses to keep a 110-room city palace as a primary residence. That leaves the original palaces in a peculiar position, too large to live in, too resonant to erase completely. On a winter afternoon in the early 21st century, a visitor stands on the corner of 5th Avenue and 57th Street, looking at the luxury department store that replaced the Vanderbilt house and at the hotel and office towers that replaced other 5th Avenue mansions. At street level, nothing suggests that tax ledgers and constitutional amendments played any role in shaping this skyline. The evidence lives in archives, scholarly articles, and a few preserved houses elsewhere. In an archive in Washington, D.C., a researcher adjusts a green-shaded lamp over two documents, the printed text of the 16th Amendment and a 1920s New York City property tax assessment for a demolished mansion. The first document is short, just a sentence. The second is a table of numbers. Between them runs the history traced in this dossier, a shift from untaxed accumulation to a system where visible symbols of wealth became subject to ongoing, documented claims by the state. The researcher copies a figure from the assessment, annual property tax $47,000, and notes it alongside the mansion's estimated maintenance cost, $180,000. Together with federal income taxes consuming 50 to 70% of investment income in peak years, the arithmetic explains why the house couldn't survive. Not because the family lost its fortune, but because keeping the house became more expensive than any family was willing to bear. Outside, in Asheville and Newport and a handful of other locations, the remaining palaces continue their hybrid existence, part business, part museum, part memorial. Visitor audio guides describe architectural styles, family dramas, and technological novelties. Footnotes in their scripts touch briefly on taxes, as if mentioning a quiet but decisive character at the edge of the frame. On paper, the story is about legal authority and fiscal policy. In Stone and Human Lives, it is about what happens when a new line on a federal form meets a staircase built as if the future would never change. In the reading room, the researcher finishes copying a figure, caps the pen, and reaches to switch off the green-shaded lamp, leaving the amendment, the tax roll, and the memory of vanished palaces sitting together in the half-dark, still unresolved.